Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, February 1st, 2023. It's 10:44 a.m. Eastern Time. So we've got, keep in mind, another little over 3 hours before the potentially market-moving FOMC announcement. I personally go into this is abstinence mode for me. I abstain from trading for the most part unless something jumps out and it looks like a quick opportunity. But particularly in anything really related to not just the stock market, but anything that's going to be impacted by currencies. That's gold, silver. From my experience, you're likely to see just whippy kind of choppy, non-directional trading. In other words, just not conducive to trading. The market kind of tends to tuck in, and everyone's just waiting to see what the Fed's going to do. So again, I'm just speaking from experience. I get grind to pieces, trying to trade the day of, and even right after. You can't beat the algos and the orders that fly in. So like I said, best to let the dust settle and not read too much into the initial reaction from the market at 2 p.m. Then Powell comes on, does his dog and pony show at 2:30. The market will then react to things that he says, and but to me, really, and we could certainly get some, a decent move out of the Fed. My guess it's going to be a non-event for the most part. Again, and you'll see the volatility one way or the other, and then the other way, and then the other way back. But I think the much bigger thing this week, because the Fed is pretty much priced in. They're going to do a quarter point, tell you they're probably going to hold off now, wait and see, or at least continue to slow the rate of hikes and wait for the data and blah blah blah, the usual stuff. Just saying, they're ready to stand by to, curtail inflation, talk the tough talk, but probably imply to the market that hey, for the time being, we've seen an abatement of inflationary forces. So we'll see what he says. To me, the much bigger thing is the earnings from the big three, much bigger: Apple, Amazon, and Alphabet. And that's tomorrow after the close. So really, again, that's just me. You can do what you want. If I see any quick trading ops, I'll certainly get them out to you. But it's probably best to just wait and see. And let those big three get out of the way tomorrow, and then we'll see how things kick off from there. If there's something big in the after hours, I'll certainly report it. If there's something big the next day, but sometimes it takes more than just a day for the dust to settle, meaning Friday, because remember, they report Thursday night, so that's really going to be, they're going to begin the regular session on Friday morning. That's when the big boys, the professionals, step in to the most part. The after hours is not a very relatively liquid market, so big hedge funds, mutual funds, algos, they all come in the regular session on Friday morning. So let's see what happens there. But what I'm going to do for you here today is, and it won't be super long, but I like to, from time to time, go over the 11 sectors that make up the S&P 500, because I like to say an index or a sector is simply a sum of its parts. It's no more complicated than that, or a little more accurately, it's a weighted average or weighted sum of its parts, because the S&P 500 and the Nasdaq 100, they're cap weighted indexes, meaning although the Nasdaq 100 has 100 companies, Apple is by far the largest component, has a much bigger impact. The bottom 20, 25 companies could skyrocket one day, and if Apple's down big, or especially Apple, Microsoft, Alphabet, and Amazon, they're going to move the needle a lot more. Just three of those companies than the bottom 25. It's just due to simple mathematics, due to their cap weighting. So, all right, again, just keep in mind. So when I say the market, an index is sum of its parts, it's really a weighted sum of its parts for those that are cap weighted indexes or sectors. All right, such as this one. So we're going to start out here. We're going to play a little game of, I've color coded all these charts. We're not going to go over a lot. We're going to look at the three major indexes that I tend to track: the S&P 500, the Nasdaq 100, and the Russell 2000 small caps. Sure, there's other ones out there, but those are the ones I tend to focus on the most and trade the most. And then we'll go over the 11 sectors of the S&P 500, and I made it very simple. I pulled out purple circles. I colored up these charts to highlight to me what are the most salient technical levels in developments to watch for right now. And I can tell you this, that my convictions aren't super high. I've gone back and told you that, hey, on one side, and I continue to maintain, when you have a lot of stocks and sectors run up to the 200-day moving averages and or their primary downtrend lines, that's an objective short entry. And I'll say that all day long. Any rally in a downtrend, any rally back to resistance on any security is an objective short entry. Now, whether that plays out or not, and I've talked about that, the fact that we've been bouncing off the downtrend line, the bear market downtrend line, all since the bear market began back in the beginning of 2021, end of 2020, end of 2021, beginning of 2022, right there. That's the start of the bear market. And we've also been rejected off these 200-day moving averages since then, give or take on the S&P. And but as I said before, usually in a bear market, when you hit it, it's one and done, and then you go back. You have the next major leg down. This time around, the market's shown some resiliency after the October lows. We had a rejection, but we powered back up, and we're out there again. So again, I don't have super strong convictions. I do favor this. But almost as equal, I'd give it maybe another thrust up to clear out a little more stops. It's almost too easy. We're almost too close to those levels. No, look, we can fail there. And again, let me go over this. And here's the takeaway. And you want to grab your notepad and do it this way. Put two columns on your notepad: bull and bear. And so what I'm going to go over is every index. I'm going to try to be as unbiased as possible. And that's not to prevent wishy-washy, confusing analysis. I can then jump on whichever one didn't pan out. That's not what I'm about. I don't manage a site for show. I trade professionally for a living, and I'm going to tell you when my convictions are strong and when they're not strong. And the more contradictory evidence you have, when I can sit here, which I'm going to do now, and I'm going to make a lot of bull cases and I'm going to make bear cases, but I'm also going to lay out the levels that are going to change things. So I'm going to say it real clear. Right now, it's not very clear. It's darn near coin toss odds as to whether the next, let's say tradable trend, and we'll want to define that maybe 8-10% in the markets. Let's just pick a number, swing tradable trend, whether that's going to be to the upside or downside. That's close to coin toss, but I'm leaning towards the downside. I'll tell you that. But again, I like to have, when you go to Vegas or whatever, let's say you're a sports bettor. I don't bet sports because the odds are almost equal. I love trading stocks. Here's why: because when you bet sports, if there was no spread, if I could pick any team, whether it's professional football, whatever sport, let's say football, and I could just pick a team to win or lose and have the odds that way, great. But what happens? There's a spread. When a team is better than another one, they're going to have higher spread to cover. They're going to be favored. You have to, that team has to win by X amount plus some, and but that's not the case in the market. So what I like to do is take trades that have a high chance of playing out and good odds. Right now, the market's mishmash, and I've told you that, and I've kind of thrown out in the recent weeks too. I've thrown out a lot of more individual trade ideas, individual stocks that I have in quite a while, and I'm giving you more sector analysis. And I do believe that best case scenario to me, if after the earnings from the big three and we go up a little bit, I think best case the market's going to grind around for a while, and therefore it's going to be more of a stock pickers market. Swing traders are going to get frustrated trying to trade the indexes. You might get a little pop one way or another. So that's, again, best case scenario, a little more upside and then limited. Whereas we could also just go down depending on what these big three do. I mean, we can go up more. I gave you some targets, but let me get to the charts here, and then A, let you decide how you want to position, and B, more importantly, highlight things that I will be watching for. Because the one thing about the markets, and I like to get all my analysis, trade ideas, and things out in advance, because sometimes things move very fast and you have to jump in position, long or short, or if you wait for me to put together a video and upload it and put everything in place and then get it out to you, you might have missed an opportunity. So here we go. All right, enough on that. S&P 500, big levels, about 410.60 right here. You can see a purple circle. That's pretty good resistance. There's some reaction highs there, most recently you have two right there. You had a trading range around it there. It was support there. Then once broken that support, we backtest, failed. So there's a lot of reactions there, and I think that's an important price level. So any pop into there, and again, trade it as you want. One could take a short trade into that resistance level. If you're betting on, it'd be a very aggressive counter trend move. If you're betting on a failure and then a breakdown. But let me just show you what's happened here. And again, so this circle here shows that we've taken out the primary downtrend line. The S&P 500, more so than just about any other index, has a very, very clean trend line. By that I mean no violations, distinct reactions right there at the highs, a couple more right there, and that's one cluster, a clean reaction there that was also in the 200-day simple moving average, two more reactions here, and then we recently broke it out. We broke above it. We broke, back test, and we're above it right now. But we're not above it by a very, very large margin, and we have, again, a lot of market moving stuff coming up this week that has the potential to either have this breakout stick and start to move away, and then again, a break above a solid break and a solid daily close above 410.60 would be even more bullish. And then it's simple. The farther you put that away, the less of chance it's going to prove to be a whipsaw breakout, false breakout. Okay, so that is it. So you want your little checkbook boxes there. Bullish. We broke out above that, and I'll just be simple on this, or say it pretty simple. It is bullish until unless it fails. Any breakout is bullish until and unless it fails. If it fails, that's pretty bearish. Although, look, it's not the end of the world if you come back right under the trend line. We've already done that once since we broke out. You also have the 200-day moving averages below. This one is the one that will really seal the deal, I believe, because of this uptrend line. It's a pretty clear uptrend line off the lows right there. Lots of reactions here. And you have, if you come solidly back below that trend line, you're going to have failed the breakout, gone back below the primary trend line. So that would be a false breakout, aka bear trap, and you would also have fallen back below the 200 days after taking them out. And the S&P 500, more so than the NASDAQ, likes to pop the 200s, suck in some money, and then reverse. It has a history of doing that so far in this bear market and in previous bear markets. Sometimes it gets rejected right on one or the other, so keep that in mind. So again, the fact that it's above the 200s, I don't give it a very high weighting because that's actually been the norm since the bear market started. The fact it's above the trend line, that is a first. If it falls below all those and moves back down, very bearish, and maybe we will get that final, big powerful wave of selling. Otherwise, we pop upside. We may be looking at some, more upside in the market in the coming weeks to even possibly months. We'll see. QQQ. Primary and BOD, or benefit of the doubt trend line. We're right on it now, no change. So I didn't get anything up. There's nothing to report this morning. We've been trading on the both the that primary downtrend line from the bear market highs again, and start of the bear market, last bull market highs in the NASDAQ. We're also at the bottom of my most likely bounce target zone, just where we got rejected before. Actually, again, in pre-market that day, we hit right here. The intersecting 200-day simple and exponential moving averages was right in the middle of my bounce target zone, and we're right there. At this time, we're back to those same 200 days. Again, the QQQ, the NASDAQ 100, has done a good job those 200 days. That's the 200-day simple right there. 1, 2. I'm not even counting. When I say 1, there's 2 candles there, and that's a second run at it. 1, 2, multiple candles there. 3. Rejection. This one, it split the crosshairs right there between the 200 simple or exponential, the red line, and the simple above, rejected. And here you have all three, a confluence of major resistance, and that's why, and I've been saying it for a week or two, this is probably the most significant, it is without a doubt most significant technical juncture in a long time. Bulls, if they can take the ball and run here, that's start moving up, especially if they take out the top, my most likely bounce target zone, bullish. And any breakout on face value, be bullish, but you gotta react quickly. If you take that breakout, there's nothing wrong with it. Just don't get married to it. If you see, this is where my other circle is, this uptrend line. We have an uptrend line off the lows right here on the daily, and nice 1, 2, 3, 4 reactions to help validate it. So if you break that, That's bearish. It'll also mean a rejection at the 200 days and the downtrend line. So that's a rejection at triple resistance. And so if you short here or you short afterwards, or you're going to take some shorts into the thing, then you just want stops somewhat above. It's a you can go either way. Now the problem is, I'm going to tell you this, that around the Fed and around these big earnings, the odds for whipsaws are pretty high, and what does that mean? You're probably going to get your stops clipped if you have relatively tight stops, long or short. So again, the safe play is to wait till the noise, all the dust settles, and that would probably be next week. But the one downside, I'm going to have to say that sometimes if the market wants to suddenly, they really love what Apple and Amazon and Alphabet are selling, it could rocket up. And if they really hate what they're selling, meaning what their earnings reports and their guidance looks like, it could be down. You could be down here by the time the quote unquote dust settles. So again, I don't have there's a lot of strategies. My favorite is, I favor the downside. I'll probably at this point, and I'll tell you otherwise tomorrow, take a small short position home, and that I will, depending on the charts, I'll tell you whether I add on to it. Initially, I felt more confident back here, starting to short for swing short positions, which I did at the bottom up to, but not above the top of the bounce target zone. So we had short entries here, swung that down, posted there. I still had those swing shorts in this range, and I started taking hedges, as I told you. The big three, Tesla, Apple, and Amazon were my favorites. And then, as I told you, I removed those hedges there and actually went long on the indexes. So I was 100% long, predicting that tech would lead, the rally, and it has. And again, how much of that has all of it panned out or not? The other thing to watch for, we're not really at, unless there's a big move quick, at risk of a bearish crossover, but I've covered this in the past. These PPO, it's just such a simple and effective trend indicator. If you just step back, look at the bearish crossovers and the bullish crossovers. Bullish crossover right there, bearish crossover right there, and it just helps you identify the major trend changes. And and a bullish crossover right there. Folks, it doesn't get much easier than that. And again, I don't use that as a standalone, but it just helps to support or refute. That's what I'm going to go over here. Refute a bearish. If I'm bullish or bearish, but then all of a sudden I see bearish PPO crossover, that might cause me to step back. Remember, you don't have to ABT, always be trading. You don't always have to have a trade, long or short. If the charts are unclear on a particular security, stand back, go find something else, or go to all cash. Anywho, that's where we're at. These are the levels to watch. All right, one more, and then I'll get to the sectors. We'll roll through those a little quicker. IWM, I'm just going to go to my busy board. IWM, this was the primary bear market downtrend line. It was nice and clean. We broke out recently. That's why I have a big purple circle here. That is bullish. 1010% bullish unless it fails. And look, we're pretty far away. However, the small caps don't rule the roost. The large caps do. That is major resistance right here at about 190, right? We're close enough to it to say we're on it now. Again, this is Fed week, a lot of grinding back and forth. Technically, we're a hair above 190, but again, on 190, we're at 190.66. You're talking, 0.5%. So that's on it. We're at resistance. But we are comfortably above the downtrend line. We broke out and made a back test. So that's circle number one, saying as long as this breakout holds, at least for the NASDAQ 100, that's bullish. But again, watch the large caps. I promise you this. If that bearish scenario on SPY and NASDAQ 100, meaning they get rejected hard, or they pop a little after the Fed or the big three earnings, and then they come down hard, and all those breakouts fail, and the large caps start to run lower, and they take out the uptrend lines that I showed you, they'll drag the small caps down with them. It's just a matter of time, so keep that in mind. As of now, the small caps are they are by far much better looking technically, especially if they can get through and clearly put 190 in the rearview mirror. So I have 190 circled, and I have the breakout circled, and I also have this uptrend line. Just like QQQ, you have a nice very clean uptrend line in which to trigger a sell signal. So if that uptrend line breaks, it's going to mean a failure of the 190 level. a break below that trend line there, and it's probably going to bring us back down to maybe another back test of the uptrend line, and then uber bearish. Oh, I need to add that circle. Uber bearish, and it's not going to happen today or tomorrow if this level breaks. Put a purple line right here. I'm trying to make that circle bigger for you so you can see it. Okay, why? Well, all what I just said there, breakdown sell signal, and then that would mean if we move back below this purple circle here, the breakout of this downtrend line would be this whole thing would be a failed breakout, false breakout, and that's extremely bearish. And to add to that, you'd also break this triangle pattern. There's the uptrend line off the lows. So that is that circle there. I'm going to bold it up. And I don't know if it's going to happen or at least happen anytime soon, but it would be a very, very powerful sell signal. And, if it happened, let me just again try to look ahead. It would mean that small caps have to drop 8% just to get there from where they're at today. You probably wouldn't want to short it, but I can tell you that would, again, if we solidly take that out, anything more than a little whipsaw down through there, it would probably usher in the next wave down the bear market. Now on the bright side, if we can break out and hold 190 and the large caps rally, well, your next target, here's a uptrend line right there. I'm sorry, not an uptrend line, a reaction high to target, and then a big old level back here, 208.50, to me a massive, massive resistance level. And so that's why, a lot of people will be, and I've already heard the early cries for a new bull market, the bear market's over. Maybe, maybe not, I don't care. I'll only know in hindsight. I only care about what I'm going to trade today, tomorrow, next week, how I'll be positioned. But I can tell you this, if we rally up there, that's massive resistance. It was the bottom of this trading range right here. That was our major sell signal right there. Back tested it and got rejected several times. And where I'm going is we can do that. We can do it to QQQ. We can do it to SPY and still be in a bear market because that would be the previous high. And the bear market would just look like that, lower highs and lower lows. All right, so again, what I'm trying to say, best case scenario, maybe a rally of another 9-10% in the small caps, and if we go break down to the downside, like I said, that's probably going to go ahead and undercut those lows. We'll still have to watch those previous lows. All right, now the sectors, and we will wrap this up. XLK, this is the biggest by far. So as I go through these sectors, if you get bored of this video and you want to shut it, at least listen to the top 5 here, because as we go down the line, I have some key levels to watch. There's certainly trade ideas for you if you're apt to inclined to trade ETFs. I'm going to go over these sector ETFs, but remember as I go through them and I get to the bottom, the REITs, XLRE, the real estate sector, and basic materials, although you might make great money on them trading them, they're not going to move the needle on the S&P because their weighting is around 3%. This is tech, the biggest, about 26%. Over 1/4 of the entire returns of the S&P 500 come from tech. And half of the returns from the NASDAQ 100. So this is important. So I probably should have color coded that purple, but I have it circled. A lot going on with tech. This is XLK, tech sector. All-time high, end of the bull market, beginning of the bear market, major reaction high. Failure also, if you can see it here, we failed. We had popped the 200-day simple moving average by a couple days, 1 or 2 days above it, and then rejected. When we got rejected off the trend line there were 101 reasons to short. Also point out the time, the least of which was this uptrend line, bearish rising wedge pattern, sell signal, rejection off the 200-day, rejection off the downtrend line. Did it again here, rejection off the downtrend line, negative divergence that time around, rejection off the 200-day moving average. See that 1-day pop? See the blue and the red lines are right here. If you can't see them in the video, 200 simple was there, exponential was there, one candle to burn the shorts and clear out weak-handed short sellers and suck in some longs, also coupled with a rejection at the trend line, and then boom, that big drop, that last leg down that we gamed. And then we set up bullish right here and that trading range broke out. And so here we are. I have a circle here. We're in close proximity. We have by ever so the slightest margin taken out the trend line, but again, that counts for little to nothing in my book because of what's on the economic and earnings calendar this week. So for all intents and purposes, we're still testing it. If you want to give a check mark, you want to be a purist, then you can say, okay, well, we're above the trend line, so I give the bull case a check. However, watch this. This is going to look just like QQQ. Watch that uptrend line. Also watch the downtrend line in the 200 days, which are just below them. A failure back through there means this whole thing, this purple circle, which right now, we're above, it means it's a false breakout, and that's going to be bearish. Now, you get a whipsaw and then back through, then, well, that was then a whipsaw, and you can get back long if you're bullish or cover your shorts. But this is, in other words, the risk of oversimplifying it, be short here, be long here. Okay? It's that simple. And that's XLK. Oh, and I should have, and I will. Watch this. We're not at imminent risk of a crossover, but you can see the PPO is starting to roll over. And again, if we break down below the trend line in the 200 days and start moving lower, that in itself, that's a sell signal, and that's the more important sell signal. And then if we get a bearish crossover here on the PPO, that's a big old additional check mark to be, in my opinion, pretty heavy short. Full on short position. Last time we had a bearish crossover was right here, and that came just before the high, and we had it looked like it wanted to make a bullish there, but it got rejected. So that this PPO is just a great trend indicator to get you in these swings and wait for the next one. We don't have it yet, but wait for the next bearish crossover. Here's a good example. We had a whipsaw here, but then finally the bullish crossover that stuck right there, and it told you that was a trend. And look, right there, it looked like we were going to get a bearish crossover, but we didn't. The lines kissed. The signal line often acts as support when tested from above or below, just like it did there, and it told you to stay long on that little pullback, at least by that indicator. Bearish crossover there. Okay, good stuff, guy. I mean, this is really, if you incorporate all this, and I know I talk, there's a lot of moving parts, but again, the more you can align, like I said, it's like making a case, a bullish or bearish case. You're never going to have an all clear where every sell signal you look at, every trend line, every indicator is clearly bullish or clearly bearish. There are times where it's more so, in a strong trending market. But right now, like I said, we are at a critical technical juncture, and I'm giving you the bullish and bearish check boxes, and really more so of not just what recently happened, but what to look for going forward after today and tomorrow, that is, really into next week. So that's XLK, tech sector, what to watch for. XLV, healthcare sector. Okay, I'm going to zoom in a little bit here. I colored this purple right here because that was at last. We've had the big trading range, the shaded area right there for the last year plus, and we've had two false breakouts to the upside followed by trendline breaks that were sell signals that sent XLV, the healthcare sector, back to the bottom of the range. And we also had two false breakouts or whipsaws to the bottom. So it's been whipsaw city. You can really say maybe a larger range. That's what you're looking at if you want to be safe. But again, the MO has been pretty clear. Now, the one problem with that, and I pointed this out, usually by the time you recognize a very clear pattern that starts to become obvious to all, that's about the time it stops working. So just keep that in mind. It doesn't mean it can't work again, but there was a breakout. Same thing. You had a beautiful uptrend line, sell signal. We've been moving lower. Again, the MO in the past has been once you pop the top of the trading range and then fail that breakout and re-enter, is that you go back to the bottom, if not all the way down below. However, what I have circled is there is a trend line, a downtrend line that's pretty clean to watch. And you also have a potential, but not yet, bullish crossover. The PPO line is starting to flatten out, starting to turn up. So if you get a bullish crossover and a breakout above this trend line, that could send the healthcare sector higher. So whereas, I pointed this out as one of the, better sectors to be short recently, I would maybe stand back. If you are short, then just watch for that. If you get that, you get the bullish crossover, well, that's going to be hard to argue. Now, the healthcare sector tends to have a little bit more whippiness, like crossovers that end up failing. Not one of my favorite sectors to engage as a sector. I've talked on that recently when I did the coverage here, but individual ones, absolutely. I've covered some of the individual healthcare stocks. UNH, sell signal right there. J&J, I've covered this one here. There was the breakdown, and boom, if you shorted it, yeah, you hit my 892 target yet 2 days ago for 8% drop, and that's where you would have covered. So there were a lot of individual. This one's just cracking. Lilly, Merck already broke down here. Individual stocks, but to go long or short. But that's the problem with the healthcare sector, is there's too much diversity amongst the business models of the components in there. Some are pharmaceutical companies, some are biotechs, some are other medical device makers, and even within the pharmaceutical healthcare, one company might have a solid pipeline making great money on their drugs, the other might be struggling. So I tend to prefer to trade these individual than just a blanket approach to that sector. All right, back to the others. Healthcare is number 2, so we'll watch it. XLF, financials, number 3. What do I have circled here? Purple. It's a busy chart, but here, I'll turn off the lines to show you real quick. This right here was great support back here. This was a big topping pattern in the financials, and then we broke right there with a sell signal. Since then, we've been rejected, rejected, rejected. We're there right now. Like the market's a hair above it, so you got to respect that. But we were a hair above it there, and we got rejected. But you can see, just like the market, after that last rejection, unlike the others, we didn't go down hard. The buyers stepped in, and they've already taken it back there, and that's why my confidence on a big plunge after the big 3 earnings this week isn't as high, nearly as high, and I'm almost coin toss high, odds that we can actually have a nice pop and a little run after this. But we'll see. That's again why I'm giving you the levels, and hopefully I'll have a much better idea next week. So the level is there, 30. It's about 36.80. That's the resistance line that was former support. You can see right here. You can come in real tight. I have it colored blue there, but. And then within there, so watch 36.80, a solid break above there. We have negative divergence. And here's one reason that I think even if we get a pop, it will most likely fail because it will be a divergent high. The PPO is not at risk. The PPO is pointing up right now. We just recently had it looked like it wanted to cross, but it didn't. We have negative divergence, but it's what I call unconfirmed divergence because the PPO is a trend indicator, and that trend is pointed higher right now. The line hasn't even rolled over. To confirm the divergence in my book, you have to then turn down and put in a lower peak in the PPO. And that would happen if we get rejected here, and there's a little minor trend line right there, a little wedge. We're just below. Again, we're not going to know until after this week. And then after this week, if I see this, with the 3rd largest sector in the S&P 500, especially tech. I told you before, the market's not going to go anywhere without tech. Tech is it's just mathematical. It's not only psychological, it's mathematical weightings. You really need the tech sector to, go down hard for the next leg in the bear market. Otherwise, it's going to hold things up. So that's XLF, 3rd largest component. By the way, it comes in at almost 12% weighting. That's as of the end of the year. So it's a recent update. XLY. Okay, a lot here too to watch. Again, that's why I'm doing this. There's a lot going on right now. That is your bear market downtrend line right there. Starts with that reaction, another one there. And we are just below it, and you also, if I turn off all the lines, we are right at those key 200-day moving averages. They define bull trends, and in a bull market, you buy pullbacks to the 200s. Once they're taken out, you're in a bear trend. You short or sell a break, and again, it's common to pop them a day or two. Multiple rejections there, and then a big leg down. Rejected off the 200, big leg down. First run at them since this point in time. So here's a sector at resistance. Again, doesn't guarantee you will get rejected, but that is the MO. It's in a downtrend. The odds favor. It's simply because we're in a downtrend, you have to say the odds favor that. There's no evidence that a bottom is in the market at this point in time. There's no evidence that this rally, as strong and as bullish as it's been and profitable if you've been on the right side of it, there's no evidence that it's anything more than another bear market rally just like this one was, which was even larger. However, we start to take out the 200s, we start to take out the downtrend line, and that's going to change things, and see they all come in together. What I circled down here was just to show you how bullish this was, and the reason that I was bullish at the lows, and decided to cover those shorts and gain the rally, because we had in some of the, and this is a big sector, Amazon, Tesla, Home Depot, Nike. So this is a big one here. So I'm watching this one closely, and that's it. There's your levels to watch. We pop the trend line. Maybe we're going to run for a while. If we get rejected, well, it's business as usual. And then you could probably draw an uptrend line here. And you, of course, want to watch those individual names as well. But, oh, I should probably put a purple circle right here. Remember, we are in a bear market. As constructive as this chart is with the bullish, divergences and a potential big wedge. The one thing I'll say is, in a bull market, you want to buy oversold. In bull markets, securities and stocks and sectors and indexes rarely become very oversold, and when they do, and they get down to that 30 level, it's usually very fleeting. That's where buyers step in and buy, and you get the next leg up. Okay, you want to buy pullbacks to the 30 level. But in a bear market, oversold tends to become more oversold, meaning it goes farther below 30, and or stays. You get persistent oversold readings. That's the nature of a bear market. Likewise, in a bull market, overbought tends to become more overbought, stays overbought for a while. So in a bull market, you don't short overbought. You'll get your clock cleaned if you short the first overbought reading, because things keep going up. Okay, where am I going? Well, we're in a bear market and have been. So therefore, in a bear market, everything's in reverse. Overbought readings are very fleeting, and they typically mark the end of a rally. So I'm circling that because we're overbought. Oversold tends to become and stay oversold. You get persistent oversold readings, more so than in bull markets. So that should have been, and now is circled as well. So that's something to watch for there. And that'll kind of maybe show the character. If we start to rally, roar up here, then and you stay overbought for a while, then it's not indicative of a bear market. Okay, it's more indicative that maybe the bear market's over. XLI, industrials, what I have circled, purple downtrend line right here, breakout, back test, and still above it. That's TA 101. The industrials broke out. This is the best downtrend line I can fit. Multiple reactions, 1, 2, 3, 4, got rejected there and then broke out. And so bullish if it takes out this 103-ish level right there, and bearish, very bearish, if that breakout fails, the breakout above that trend line. I can't extract any useful information from these indicators. PPO and RSI are flattening out, so I don't have a strong opinion on XLI industrials, but I can tell you they're near the top of their previous bull market highs, much closer to the highs than the bear market lows. And it does speak to the strength of the economy when the industrials are up there. So far, and the story of this bear market has been all about tech. Tech let it down, and that's usually the first. When the economy starts to turn, you see the high growth sectors go down. So it's not unusual for a bear market, and I predicted before this one even began that it would play out much different from previous bear markets, be a much slower roll. And so maybe we've already seen some rally in tech. If we are in a great bear market with a lot more to come, ultimately the industrials will roll over. But again, right now you can't give them anything but a bullish check mark. The fact that they're near their all-time highs, and more importantly, comfortably above the downtrend line that they recently took out, back tested. So they get a bull check there unless that fails. All right, next up is XLC, communication sector. I'll talk a little faster, go through this a little faster, because again, as I go down the line, the weightings don't matter as much. Now this has some important companies. It has Meta and Alphabet in there, Alphabet being a big one. But this one only accounts for about a 7.28% weighting in the S&P 500. Circles are this beautiful basing pattern with beautiful positive divergence, everything pointed out. And then so the basing pattern had resistance right here. It broke out and we're above it. So you get a bull check mark, 110% for, first of all, coming off a divergent low on the daily time frame, and then a breakout right there. And so what I've circled is, here's what to watch on this one. You have an uptrend line, right here, a break of which would be bearish, but it really need to see a failure back into this basing pattern or trading range there. That would be a check mark for the bears. That hasn't happened yet. Right now, we're above that, and that's bullish. So right now, this one gets a bull check mark, and unlike a lot of sectors, because it got beat down the hardest, really like a subsector of tech, you haven't visited the downtrend line since all the way back here when the bear market began. There's a lot of reactions to validate it. So I have a circle there that if we do get an upside, some upside after the earnings this week, that's probably where XLC is going to go. But right now, it's testing and struggling with the 200-day moving averages. You can see that. Look at that. The red line's a 200 exponential. The blue is a simple. 1, 2. I mean, we've been first it struggled, tested the simple 1, 2, 3, went up, ran, hit the exponential, and it's been trading there for the last week or so. And this is the first time it's even checked those levels since really losing them back here. That's when the bear market, right after it started, and you lost the 200s, checked the 200 simple there, got rejected, and really haven't even checked them until now. So the fact they're checking them for the first time, they're at resistance. So I'm not going to give it a bull. Well, I gave already bull check marks here and here. Right now, this is kind of a question mark. It's bulls win above that. They win up to that level. Bears win if they get rejected here off the 200s, and then that trend line gets taken out. And a huge win for the bears if we fall back below this recent trading range right here. But until then, that's near-term bullish, near-term uptrend, and one more circle to be added. High level. If we get a bearish PPO crossover, it would be a high-level bearish PPO crossover. Remember, by every single metric that just about there in technical analysis, this communication sector is in a downtrend or bear market, and you have an overbought reading, the first overbought reading on the RSI since the bear market started back here, right when they topped. So again, there's a lot of evidence, despite the strength of the current rally, that it may be in its final legs. And again, it'll start to show its hand, I think, after this week, which way it wants to go is what I mean. XLP Staples, again, not a huge sector, 7.2%, but one worth noting. You have your Walmarts and Procter and Gamble's and Coca-Cola and Costco and things like that here. Downtrend line, breakout, this purple circle, that was a breakout. It was powerful, impulsive. Nothing goes up forever. You put in a divergent high right at the previous reaction high. Sell signal broke down, and that took us in for the first and only back test so far. PPO is poised to make a bullish crossover. You can see it's turning up right there. In fact, it just has by a hair. So I'm going to give this a bullish check mark for now because we took out our bear market downtrend line. Successful breakout, bull check. Successful so far back test, bull check. What would undo that? A failure back below that line. But if you get a bullish crossover, you're probably going to see more upside in the staples. And yeah, that's that. XLE Energy, one of the more bearish sectors right now. This is our primary uptrend line. Needs to break that. And if it does, you can see I circled bearish crossover in the works, and divergent. We made almost an equal high there, and that bearish PPO crossover, I think nope, has it happened yet? Yeah, just happened. So you have a bearish PPO crossover. But remember, I threw this one out as a trade idea back here, but I also posted covering it there because I expected a bounce off the first hit of T1, but it's still T2. Still, I'm leaving T2, T3, potential T4, potential T5 there because we hit the first support. It was good support. There were a lot of reasons, that said we'd bounce there, and we bounced all the way back to that. This is big level here. Let me zoom in. I should put a purple line right here. Or purple circle, that is. Why? Because look at that. That is a so far triple top high. This is as far as the energy stocks have ever gotten in history. That's their all-time bull market high. Got hard rejection off there, rejected there again. Like the broad market, we rallied back up, without much of a correction. We're back there again, but that's a big level. Keep it very simple. Bullish if we take it out with conviction and don't, anything but a whipsaw. Bearish if we take out the trend line. Based on the posture of the indicators, I highly favor the downside break. This is one of my favorite sectors to short right now. ExxonMobil needs to break this trend line here because this is the 800-pound gorilla in the sector. There's a beautiful wedge, big negative divergence. ExxonMobil breaks that, it's dropping to 102.51. I would put very good money on that, and very good money you'd get a bounce on that because that's a primary uptrend line and price support. Then if that goes, that's an even more powerful sell signal, and that'll take the energy sector down hard. Chevron already broke down from a comparable uptrend line, which also makes me think Exxon soon to follow. Right there, big divergent high, sell signal. Chevron's coming down to 167 and the trend line, and then when that goes, just like Exxon, lights out for the energy sector. A couple more. XLU, again, not going to move the needle, but here's a downtrend line. If it takes that out, that's going to be bullish. But again, this one's such a low weighting, 3.17%. It's not going to make a difference on what the S&P does. And there's support there at about 68. Bearish if it breaks below 68, bullish if it breaks above 70, and the downtrend line right there, if you care to trade the utilities. XLB, same thing, lowest weighted sector at 2.74. So although they, a lot of these stocks, make great trades, you have FCX, Freeport, McMoran, other, Dow Chemical, you have a lot of other industrial or basic material companies in here, but negative divergence right here. That's why I have that circled with a PPO pending, not yet, close to PPO starting to roll over. So it looks like it's going to happen soon, and it looks like this is one of the more attractive short setups right now out there, and that's XLB. The trend line's not great. I don't have a great uptrend line to draw which to trigger short. I just want to say that they with the divergences, it looks like the upside's most likely limited. So there's your analysis. And again, the most important, or what I started with, the three sectors, watch those levels. Then the the three indexes, the S&P, NASDAQ 100, Russell 2000 small cap, and then of course watch tech, healthcare, financials, and some of the others I covered. And that's it. If I see anything that stands out before or even after the FOMC meeting announcement today, I'll get it out to you. Otherwise, I might just sit back and maybe even take a little time off. Like I said, I'm kind of in abstinence mode from trading right now. There's no reason to get grinded into pieces today or tomorrow, but we'll pick it up most certainly after that. This has been Randy Finney with Right Side of the Chart. Have a great day.